Preferred shares and preferred dividends. In addition to common shares, company can issue preferred shares. Usually, preferred shares receive a fixed dividend that is either expressed as a percent of its par value or as a fixed dollar amount. Preferred shares are preferred due to several features, one of which is that they receive their dividends before the common shares. Hence, they have the first preference in dividends declaration and payout. Usually, the amount of dividend is fixed, whereas the amount of dividend payout to the common shareholders is variable. In case of liquidating the business, they also have a priority in settlement of their dues before common shareholders. Usually, preferred shareholders don't have the right to vote as common shareholders. Let's assume that a company issued 500 preferred shares of $100 each and yielded 10% dividend. The amount of annual dividend is equal to 500 shares multiplied by $100 multiplied by 10%, which is equal to $5,000. However, it is important to note that although expressed in a percent format, these are dividends, not interest. So in case that the business decided not to declare or distribute dividends, preferred shareholders are not going to receive any dividends. It is worth mentioning that there are two types of preferred shares, cumulative and non-cumulative. To illustrate, let us assume the previous example and further assume that those shares are non-cumulative. Let's assume that in year 1, the business declared $7,000 in dividends. The company now has to pay $5,000 in the form of preferred dividends first, and then the remaining $2,000 will go to the common shares. In year 2, the business didn't distribute any dividends. In such a case, both the preferred shareholders and the common shareholders will receive nothing. In year 3, the business declared $12,000. The preferred shareholders will take dividends of $5,000 for the current year, and the rest, which is $7,000, goes to the common shares. Now let's assume that the preferred shares are cumulative. Assume that in year 1 the business declared $7,000 in dividends, and the company now must pay $5,000 to the preferred shareholders first, and then the remaining $2,000 will go to the common shares. In year 2, the business didn't distribute any dividends. In such a case, both the preferred shareholders and the common shareholders will receive nothing. However, they will record $5,000 in arrears to the preferred shareholders, to be paid when the business declares dividends. In year 3, the business declares $12,000 of dividends. In this case, the preferred shareholders' dividends are first paid the $5,000 in arrears. Then they will receive $5,000, which is the dividends for the current year, and the remaining $2,000 goes to the common shareholders.